Hi everyone, Adam Morris here, and welcome to the podcast. I'm joined, as always, by my partner in crime, Daniel Welling. Today, we are diving into a topic that's gathering real momentum in the MSP world, the Employee Ownership Trust, or EOT. To guide us, we've invited Richard Coulthard from Ison Harrison Solicitors, who not only advises on EOTs, but has taken his own firm through this journey. In the next 40 minutes, you'll discover how an EOT actually works, from selling shares to a trust, right through to who really runs the company day to day. The eye-opening tax advantages for sellers, employees, and the business. Yes, zero capital gains tax is on the table. And whether an EOT beats a traditional trade sale or MBO for your exit goals, including realistic timelines, earnouts, and funding options. If you're an MSP owner curious about succession, legacy, or simply maximizing your business value, this episode is tailor-made for you. Let's get started.
Richard, thanks for joining us.
Thanks for inviting me. It's great to be here today.
You're very welcome, and both Adam and I are really intrigued by our topic today. Well, EOT, Employer Ownership Trust, a relatively young concept, but gaining traction, increasing traction within the MSP space. So, Richard, when you said you'd be happy to come on and give us a bit of an explainer, I couldn't say no. So Richard, over to you. Perhaps you could just give us a very brief introduction to kick us off, and then Adam and I can perhaps probe you with some questions as we go.
Yeah, absolutely. I'm delighted to be here. So Ison Harrison Solicitors, we ourselves are 100% employee owned. So I'm not just talking about the legal aspect of this, but also the practical side, having been through it ourselves. So Employee Ownership Trust, EOTs for short, actually came into force over 10 years ago, but no one really understood them. They're a little complicated at first glance, but actually they've become increasingly popular, particularly in light of tax changes around capital gains tax. And people often talk about the John Lewis model. It's not technically the John Lewis model, but people refer to it in that way. Essentially, what it is, the owners of the business selling at least a majority stake, but more often than not 100% of the shares in a business, to a trust. The beneficiaries of that trust are the employees of the company. And so this is a form of succession planning, ultimately. Importantly, the sellers don't have to leave the business. In fact, ordinarily don't leave the business. They will stay as employees. But it's a way of them realizing the capital value of the shares. There are a number of tax benefits to all the parties concerned, the seller, the employees, and the company of this. And that's one of the reasons these have become so popular. So the seller, the existing shareholders, can sell 100% of the shares in the business, or less. They have to sell at least 51% to get the tax treatment, but most will do 100%. And they pay no tax whatsoever. So it doesn't matter whether they sell their business for, 500,000 or 500 million. There's no capital gains tax to pay on the disposal of those shares. Subject, of course, to compliance with various rules. Not quite that straightforward. The headline is there's no tax, no capital gains tax payable on the disposal. Not only that, but the employees going forward after the sale can earn up to £3,600 per year as a profit distribution and pay no income tax on that whatsoever. Still pay national insurance, but there's no income tax. And any distributions above that level are subject to income tax. But it's akin to a dividend. It's not technically a dividend, but the profits going forward, subject to any contractual requirements in terms of repaying the seller their capital, which I can come on to, but the employees share in the profits of the business, and a large amount of that is tax-free. But not only that, the company also can have a significant corporation tax saving, because any employee distribution pays, or any profit distribution to the employees, comes off the profits of the company and therefore reduces the amount of corporation tax that is paid. So unlike a dividend, which comes out after corporation tax, doesn't affect your profits, a profit distribution to the employees under the trust is an employment expense, so reduces your profit, thereby reducing your corporation tax. So there could be significant savings all around.
Can I just check, is that up to that maximum 3,600?
No, it's whatever you distribute. So as an example, as a firm, we converted over 3 years ago now, 3.5 years ago. We've done 3 separate distributions to our employees over that time. First year we did 3,600. Second year we did 4,000. Third year we did 4,000 per employee. Now we've got over 300 employees. Call it 1.2 million thereabouts. That entire 1.2 million comes off our profit, and therefore we only pay corporation tax on the net figure, having already paid that distribution. So the corporation tax saving to us, well, I can't do the math in my head, but what, 300,000, something like that, in corporation tax saving. So there's a lot of benefits to this avenue. From the seller's perspective, their question is going to be, well, how do I get paid? I'm selling my business.
And sorry to interrupt, Richard. Sorry, just one more question on that point. Are the trusts and the committees that are managing the trust, or the leadership team of the company, are they using this tax efficient way to compensate salaries and people in general? Or is this always deemed a kind of bonus structure? How do those sort of components equate?
Yes, so you're not replacing existing salary. So what you can't do is take someone who's on 30,000, let's say, and reduce their salary to 27,000 and say, well, we'll pay you £3,000 as a profit distribution. That's tax avoidance. That's not allowed. So employees' contracts of employment do not change. They are still employed by the company on whatever terms of employment they are currently employed. This is entirely a bonus linked to the profits of the business.
But in theory, you could hold their salaries at 30,000, and you could increase their bonuses year on year.
You wouldn't, because of tax avoidance rules. They're two completely separate issues. Their employment is their employment, and they just happen to be a beneficiary of the trust, subject to certain qualifications.
Got it.
So,
okay.
So you, for instance, you normally exclude short-term employees, those up to 12 months service, from being a beneficiary of the trust. So they've got to have been there for a certain period of time. There's also objective rules about how the profit distribution works, which I'll explain separately. From the seller's perspective, they've sold their business and they need to be paid for that value. Ordinarily, what happens is the seller will take any excess cash that's in the business on completion. So quite a lot of businesses have built up sums of money in reserves over a period of years, which is not very easy or tax efficient to get out, because they'd have to take it as a dividend and be taxed accordingly. So normally the seller will take that excess, or the bulk of that excess cash, on deal day, on completion. And then the rest of it is then paid out over a period of time out of the profits of the business. And typical earn-out periods are between 6 and 10 years. If you've got a business that you're valuing with a 5 times multiple, for argument's sake, 5 times the average net profit, EBITDA, well, obviously EBITDA is before your taxation, so you're going to be looking at a longer period than that, which is why it typically ends up being somewhere between 6 and 10 years. You can finance it, that is possible. Some banks will give, lending against invoices or against assets in the business, property, or general cash flow lend, so that you can finance some of it if that's what you want to go down, but that's entirely down to the discretion of the vendor and the management team. But ultimately they're paid out over a period of time at an affordable rate linked to the profits of the business. That's how they get paid out. The sellers stay in the business as employees, so they can still be directors, they can still run the business, they can still get a market rate salary. They don't get dividends because they're not a shareholder anymore, but they can still run the day-to-day operations of the business. Technically, there are two layers of management, so to speak, within the business. You still have your board of directors of the trading business, which run the business on a day-to-day basis in exactly the same way as any other business, which can include the sellers. It can include other members of the management team, but they make day-to-day decisions. Sat above the directors of the business, there is then the trust, and the trust has trustees, and they act as representatives of the shareholders, being the trusts, and therefore the beneficiaries of that is the employees. And that is made up a combination of the sellers. They can be trustees as well. They can't have a majority on the trust, so you can't have two sellers and then those two sellers are the sole trustees. They can't have a majority, but you'd normally have the sellers. You'd normally have an independent, so like a non-exec director. You'd probably have another board member, at least one other board member, so someone else on the management team who wasn't a seller. More often than not, you'd have an employee, so someone who's senior, probably long-standing, but not necessarily a director. And they are there to make decisions that would normally be made by shareholders. So, if they want to sell the business or if they wanted to liquidate the business, certain other bits and pieces are required. But the day-to-day operations is still run by the directors. That's often one of the questions that we get asked is, do the employees run the business? No, they don't. They might have a greater degree of influence and say, and they've got a vested interest in the success of the business, but they're not making decisions as to who gets what pay rise or, what contracts they enter into or anything like that. So statistically, employee-owned businesses do outperform their competitors, and there's been a lot of research into this. And the rationale for that is relatively obvious, that the employees are directly benefiting in the success of the business. So the more successful the business, the more profitable the business, the more they ultimately are capable of earning. I said I'd come back to the point of profit distribution because I think that was one of the questions that you were wanting to understand, is how that works. What it is not is a bonus scheme whereby, the directors can go, well, John gets this, Sally gets that, Peter gets the other. You can't have that discretion to pick and choose what people get. You have to have an objective set of rules about who gets what, and there's only 4 bases on which it can be linked. So it can be fixed, so all employees get the same. It can be linked to remuneration, so higher earning employees get a bigger share of that pot. You can link it to length of service, so longer serving employees get a higher share. And you can also link it to hours worked, which are largely discount, but you can discount for part-time workers like that. And you can do a combination. So you could go, well, 50% of the pot is fixed, so everyone gets the same for that portion of the pot, and 50% is linked to remuneration, let's say. Okay. So there's ways of doing that. Now, outside of that, one of the questions we get asked was, how do we reward the management team? How do we reward the people who are going to be running the business and driving the business forward? Because they're not going to have any shares, probably. You could have the management team buying some of the shares potentially. That is an option. It gets a bit complicated, but you can do that. Most commonly, what people do is they have what we'd term to be a director's bonus. So they'd either ring fence a certain proportion of the profits of the business and go, that's paid to the directors, which could include the sellers, for example. Or they might link it to the amount of the employee distribution, the profit distribution. So they might go, well, an equivalent sum to the profit distribution to the employees is paid to the directors, but there's only a handful of directors, therefore they get a bigger share of that distribution, and they get the employee profit distribution anyway, because they are an employee. So there's different ways of doing that. You could do something like growth shares for the directors. The important thing for all of this, though, because it isn't more complicated, everyone's got to be incentivized. The seller's got to be incentivized to make sure that they get the right price. They're going to get paid in a timely manner. They've got the protection and security for that. The management team, who are not sellers, need to be properly incentivized, not just in the immediate aftermath of the sale, but long term for the success of the business. And the employees have got to see some sort of tangible benefit. So it's all well and good saying, "Oh, we've got this great scheme. We're going to do an EOT," and the employees are told, "Yeah, but you're not going to see any benefit out of that for 10 years. Once the seller's paid off." So it needs some careful thought and planning to make sure that benefits everyone during that period of time. In terms of the process, you need to get tax clearance. A HMRC need to approve this. So the sellers can't just say, "Well, I value my business at £10 million. I know I've only been trading 6 months, but it's definitely worth £10 million. So HMRC do check that the value that the sellers put on the business is fair and reasonable. And it has to be independently verified by an independent valuer to make sure that it is fair and reasonable. So they need to approve that. They need to improve the underlying structure of the EOT. You may need to get consent from a regulator, probably less applicable in the MSP space, but if you are regulated by a particular entity such as the FCA, for example, you might have some of your listeners who have FCA approvals or what have you, so they may need to have it approved because it is a change of ownership ultimately. That needs to be thought through as well on that. And I think bringing the management team into the discussions relatively early can be hugely beneficial. That's how we approached it when we went through this process. We had 3 original shareholders, 3 founders at the time, and then 5 of us, myself included, came in as the sort of new directors to run the business and sort of take over that operation. And we were brought into this very early in the process and actually helped shape how the EOT was structured before it went through. We actually communicated to our staff as well about 6 months before we completed and got their engagement as to what input they wanted to have in terms of running the business. Now, don't get me wrong, we've had some quite ridiculous suggestions, which I won't repeat, but we've also had some very sensible suggestions from people as to ways that we could make efficiencies in the business. And we've seen a huge benefit from the conversion. When we converted 1st of January 2022, we were about £16 million turn, and we'll be over £30 million this year. So we're not far off doubling our size in what will be 4 financial years. You got a question there then?
We've just had such a lot of information there in a short space of time, so can only thank you enough for that. Yeah, very clear explanation. I've got about 800,000 or 900,000 questions for you. so I'm going to start. I'm going to start with the first one and sort of raise above some of the detailed questions that I'm sure some of our listeners have. To perhaps, why is this format available? Why are the tax benefits so attractive? What is the intent of this tax legislation to do? Is it to keep businesses centered in the UK with local ownership?
There's a range of reasons for this, and almost regardless of your political allegiance, shall we say, there's kind of something for everyone on this. It ensures a wider distribution of wealth. So, whilst is losing, shall we say, the revenue from capital gains at the upfront, it increases the spending power of a wider proportion of the population. Now, if I take ourselves as an example, we distributed, as I said, £4,000 per employee to circa 300 people last year. I don't know what they've all spent it on, but in all likelihood, that's been spent on, doing out the kitchen, buying new furniture, paying for a holiday, paying off debt, all of these things. So that money is going back into the economy in other forms, VAT, corporation tax for other businesses, all of these other things. So the money eventually does go back around in a circle. It's not like the government ultimately loses this. If that money, my theory anyway, is if that money is retained within private equity or a small number of people, that money is more likely to be saved, invested, potentially not within the UK. So you've got to think on a much broader basis than purely, well, hang on, this is costing the government money in terms of capital gains tax. Because actually, when you look on the wider piece, it results in a wider distribution of wealth and greater parity of wealth distribution longer term.
Okay, very good. Makes perfect sense, and I think it it settles in my mind that there's a longevity to this. As you say, it's perhaps not going to be tinkered with too much by successive, perhaps different governments. And
Yeah, I mean, we're going to only work on what the tax rules are as they are today. Now, what I would say is the government did consult on this last year in 2024 and actually revised some of the rules in October 2024. There was, and that was really more around compliance and making sure that people are doing it for the right reasons and the valuations are fair and things like that. But they haven't changed any of the tax rules. And my feeling is if they were going to change the tax rules, they would have used what was quite an extensive consultation last year to do so. So my view is I don't envisage any change in the immediate future around taxation rules for EOTs. That's not to say it would never change, but if people are thinking about succession planning and want to look at this as a viable option, I would do so now, because your tax rules will be based on when you complete the transaction. Now, you've got to bear in mind that there have obviously been changes around capital gains tax and business asset disposal relief. So business asset disposal relief was up to 10% pre 6th of April 2025. It now goes up to 14% for this tax year and will increase to 18% in April 2026. The majority of business owners qualify for that relief, and if you don't, then you're going to be paying tax at 24%, and you're going to be paying it at that rate on anything over £1 million anyway. So the tax savings are significant. What I would say is, if a seller is solely looking at this as an option for tax benefits, it might not be right for them. You've got to be on board with the principle. The tax benefits are certainly a nice to have, but I don't think it should be the sole reason to do it.
Not having the tax tail wagging the transaction dog.
Correct.
We'll come back to the podcast in a minute, but first, I just want to introduce you to the mentoring service from MSP Finance Team. How long will you carry on struggling on your own, juggling cash flow, feeling like you're barely making ends meet, when the very reason you started your MSP was not just to help others master technology, but also to secure your own financial future? Or perhaps you've grown your MSP to a good size and are looking to prepare for an optimal sale or acquisition, but have never done it before. We've walked in your shoes. We're ex-MSP owners and have built our businesses from startup to exit and know exactly how it feels to be constantly firefighting or struggling to grow profit. And that's why our mentoring, or call it coaching if you prefer, exists to help you achieve the rewards you set out to achieve in the first place. More profit, more time, and the freedom to focus on what truly matters. So you're probably asking, why should we work with you? Well, we deliver results. Here are just two examples. A 10 million MSP with a 7-strong leadership team but lackluster results. Within just 2 quarters of working with us, their profits began to climb. At the end of year 1, their profits will have jumped from 300k to 1.3 million. But we're not that big, I hear you say. Well, we work with smaller MSPs as well. A 400k MSP was suffering a 10% loss before we engaged with them and were struggling to move forward for years. Again, within a 12-month period, we've turned that business around. They've got new clients, they've got their mojo back, and they made a 10% profit this year. If you'd like results like this, book a free consultation now at mspfinanceteam.com, and we'll discuss a burning issue that's been holding you back and give you several key actions to take away and implement completely free of charge with no further obligations. Don't settle for less. Make your MSP everything you dreamed it to be.
Yes. And I guess also in the case of your experience, the value of the entity will change over time. You're locking in a value today, but if you retain that business and were able to emulate the performance the business has had post the EOT, effectively you'd be, maybe it wouldn't be worth twice as much, but it would certainly be worth, you would hope, more as a business, double the size than it was before in a short space of time.
There's a lot to consider here, and this is one of the reasons I say that most people do 100% sale, and because the tax treatment is a one-time deal. Right. You can't sell 60% today and then sell 40% 2 years down the line and get the same tax treatment. You could still sell that 40% to the trust, but you're going to be taxed as capital gain tax in the usual way. So it's a one-time deal. But it's a great mechanism, for example, where you've got business owners who are at different stages of their life. We frequently advise business owners where you've got one owner who's 10, 15, 20 years younger than somebody else, and they recognize the need to release their value, but the younger shareholders saying, but I don't want to retire. So you have a situation whereby they all realize their value, but the younger shareholders can still stay running the business, still stay getting a fair salary and a profit distribution and bonus and all of these things to keep them engaged in running the business.
Versus perhaps the alternative where the older shareholder wants to exit, perhaps the younger shareholders, or indeed the younger management team, if they were prepared to take the risk, they could potentially fund an MBI.
Yes.
Yeah. So, but of course, that would not perhaps be as tax efficient for the seller.
There's also some other complications in terms of, and I don't want to get overly technical, but in terms of if you're only exiting one shareholder, not the other shareholders, how that is going to be funded, whether the business has got the money to do that, whether you can get permission for what we call a company purchase of own shares. And if that's not possible, then you're looking at creating holding companies and things like that. So you can go down that model, don't get me wrong, but there are some complications to think about, is what we're saying. So we certainly had, I said, going back to our personal experience, we had 3 founders. One in particular was quite clear that he wanted to be out of the business within 12 months of completion, which is exactly what he did. And we've got the other 2 founders are still in the business, but they were at different stages in their life and what they ultimately wanted to do. But this was a solution that actually meant that they all crystallized their value, and the 2 that wanted to stay working could stay working and probably will continue working for a number of years still to come. But the one who wanted to go could go.
So one of the fundamental differences, if I understand this properly here, if you're sitting here as the owner looking to sell, is the degree of earnout. So if you're selling as an actual one-off transaction, you may have a 1 year, 2 year earnout process on that, or nothing at all. Here we're talking maybe a 5 to 10 year type earnout process. Now, yes, you've got your tax benefits, but you've got a completely different journey here in terms of the outcome. So if I understand this correctly, this is less about the money. It's more about the legacy. It's more about what you're leaving behind. It's more about what that business is and where you want it to go and the stewardship behind it. Because if you were doing this purely commercially, you'd never take that risk, surely. You would just take your money.
It depends on the individuals involved. And so broadly speaking, you should get a similar value whether you go down a trade sale or an EOT. Okay, in theory, they are both market value. Okay, the difference with a trade sale to a third-party buyer is you are probably, but not definitely, going to get more on day one. Okay, so and you're in this market probably unlikely to get the full amount on day one, but you'll get a much higher percentage typically. And you're right, you're going to have a much shorter earn-out period than what you would have with an EOT. So that is a positive for a trade sale compared to an EOT. Downside of a trade sale against an EOT is you've got to find a buyer. They're probably going to do a more rigorous due diligence process. Your tax treatment is different. You're not going to be in control of the business post-sale. So pros and cons to that route. That's one avenue. An EOT, positives, tax treatment, you'll have a greater degree of control on the sale. Downside, absolutely, your earn-out period is going to be much longer and going to be linked to the profits of the business going forward, but that would suit a seller who wants to stay in the business for that period of time. This is going to be about crystallizing a value and being paid out over a period of time while still being able to run the business, whereas a trade sale, they probably want to keep you for a period of time, a year, 2 years maybe, but they're not going to have control. You're going to have another shareholder who's going to want to run things their way and things like that, and that's not for everyone in terms of sellers. So there's pros and cons to each avenue, and I'm not saying EOTs is a right solution for everyone, because it's not, but it is a solution for some, and it's still relatively novel, relatively misunderstood, and so it is something that needs to be considered as part of a wider succession planning piece of advice as to whether it's a trade sale to a third-party buyer, whether it's a management buyout, whether it's private equity, whether it's an EOT. It's one of a number of factors that any business needs to be thinking about when they are thinking about succession planning.
And if we get back to this earnout process, and let's say, rather than a 5 to 10 year timescale, we want to reduce that. So we want to get some funding now, because we want, say, 50% to be funded externally, and let's reduce that earnout to 3 years or 4 years, say. That could be a viable option.
Absolutely.
And one of the things I understood, though, was there are certain barriers to that kind of facility from an earnout perspective around the size and scale of the business and the leadership team to take the company forward. So what are the kind of guardrails around that?
So let's firstly look at what do we put in place for the seller to either force overpayment or early payment of that deferred payment, but also to encourage that, because the trust could always decide to overpay. So there's two safeguards we put on that. Firstly, we normally say we're going to set the deferred payments at whatever level based on current performance of the business, okay? But we normally also suggest that actually if the business starts doing really well and starts accumulating cash which isn't committed for corporation tax or something like that, that the trust has to pay a certain proportion, say 50%, of excess cash above a certain level beyond what's needed. So that's a contractual requirement. You must overpay in certain circumstances. The second angle, however, is we normally suggest that there's an interest provision that on the deferred payments. You might have an interest-free period, and then an interest rate that applies between, 3 and 6 years, and then a higher interest rate that applies for 6 years plus. So for the management team, there's almost an incentive to look to refinance that, because it could end up being as cost effective to take third-party funding and clear that debt than it would be to pay interest to the founders. Practically, in terms of achieving funding through third parties, there are certain banks that are increasingly in favour of funding this type of transaction. One of the challenges could be that the existing management team probably don't want to be given personal guarantees. So any third-party funding would have to be on the basis that the bank isn't going to insist upon a personal guarantee. Now, it's going to depend on the nature of your business. What's the risk to the lender? What other assets, if any, have you got to secure against? Is there a property? Is there plant machinery? Is there a debtor book? There's all of these usual factors when it comes to financing any deal, but personal guarantees are probably not going to be on the table for any lender. So that can be a challenge, but it always comes down to how much you're looking to borrow, how successful a business is, and all of those usual underwriting considerations.
I'd love to ask some more questions about valuation, but somehow you've already run out of time. So we're definitely going to have you back again, Richard. Really interesting topic, and I think, no disrespect, I've probably now got more questions than I had before. But I think that's because you've done such a thorough job in opening our eyes to this topic. So if any of our listeners would like to carry on the conversation directly, how best to get in touch?
Yeah, so you can contact me by email or telephone number. So email is richard.coulthard, COULTHARD, at isonharrison.co.uk, or telephone 0113 284 5000. Or we have got a full guide on our website as well, isonharrison.co.uk. We've got a full guide to converting to an EOT, which they can download and contact us with questions for further consultation.
Brilliant. Thank you. Thank you very much. And any final thoughts from you, Adam?
Well, again, I think this is just scratching the surface, isn't it, of a highly complex and emotive subject, actually. And I think, as always, the thoughts here are that there's so much to it. Start building a plan and talking to different people around this and start to really get to grips with it. But for me, I think the fundamental is less about the money. It's about the legacy. I think for me, I think that's got to be a clear reason for doing this. As you said earlier, above the tax breaks, above the earn out, it's got to be something around what you want for this business and the people in it, I think, for me.
Yeah, I'd agree with that. And I think it's very emotive. I will always say to business owners, you need to be thinking about your exit probably 3 to 5 years out and structuring your business accordingly, whatever exit looks like. And it's going to be different for everyone, but you need to start planning it, get the right solution for you.
Wise words and a great way to finish up the episode. So thank you very much for joining us.
Thanks for your time.
Thank you.